If you own stocks and you don't know about covered calls, you're leaving money on the table. Coming up next, right here. Hello, I'm Don Singletary, and if you're a stock owner, you're not making money three ways, you're leaving money on the table. Of course, capital gains from your stocks, the dividends that some of your stocks pay, and today we're going to talk about covered calls. It's probably the most conservative use you can ever make of stock options. So conservative, it's approved for use in self-directed retirement accounts. Whether you're trading in a regular account or a retirement account, there's some things you should know about the covered call. Only 3 of every 100 people who own stock trade options at all, and they could be missing out on potential income they didn't even know they had. I recall my first experience when I was a stockbroker back in the 1980s, the first experience I had helping someone with covered calls. There was a local businessman, very successful chain of retail clothing stores named Wally. He brought in the shares he had found in the safe at his home, and we put them in his account and wrote covered calls on them. He had 38,000 shares of Bell South stock, and we wound up making him an extra $92,500 over the next 12 months by writing the covered calls. This is a great example of how a little bit of knowledge can increase your income, and selling covered calls is something you should definitely know about if you own stocks. More recently, just last year, I lived near Atlanta, and I went out for a Mexican lunch at a nearby pub from our home. And I struck up a conversation with this gentleman, Ed, and I asked him how he was, and he explained he'd just retired. He was very happy. I said, "Where did you retire from?" He said, "From Georgia Power." Now, I know Georgia Power is owned by Southern Company, and I immediately asked, "I hope you got a lot of that Southern Company stock." And he said, "Oh, yeah." He said, "I've got $2.5 million worth of that stock. It's about 43,000 shares. So naturally, I asked him, did he ever write covered calls on it? And he had no idea what that meant. So I explained to him I write financial books. I sent him a copy. And now every time I see Ed down at the pub, he buys me lunch. Now, I don't want you to think you have to be wealthy or retired to be able to sell covered calls. All you need is at least 100 shares of any stock that has options to begin. Now let's go through a real example of how you can sell a covered call. In our scenario, let's say you own 100 shares of Disney stock at $95 a share. Today, it's trading at $110 a share. You have a $15 a share profit times 100 shares, or a net capital gain of $1,500. Here's the scenario for writing our first covered call here on Disney stock that we own. We own the stock at $95 a share. It's currently trading at $110 a share. And we're going to be using a strike price of $125 a share on the covered call that we're going to sell. Now the red and green line, diagonal lines there, represent the profit and loss, the red being the loss and the green the profit. And you can see as the price of the shares go up, so does the profit. But when we sell a 125 call, it changes things. Here's how it works. When you sell a call option, you have the obligation to sell the underlying, that would be our Disney stock, at the strike price of $125. In other words, if it goes up to $125, you make profit up until that point, but after that, you forego that profit. And in exchange, you get to receive the premium or the price of the option that you sold. That's the trade-off. So let's review here. We've sold on February 7th is the trade date of this transaction. We sold the 125 June Disney call, which expires on the 21st of June, 134 days out. We received $1.12 for the option, which means $112 because there's 100 shares per option. Now let's look at the possible outcome scenarios. Number 1, at expiration of the option, 134 days out on the 21st of June, if the stock is $125 or under, we profit the $112. In other words, we sold the option, it expires worthless, and we keep the premium. so our cost basis for the stock has now been reduced by $1.12. Can you imagine year after year, and several times a year, reducing the cost basis of your stock? It would mean a lot more profits over time in your account. Now let's look at scenario number 2. This one is the stock is at $125 or higher. Well, you bought it at $95, so you get a nice profit on the stock as it's called away, plus you get to keep the $112 you received for the option you sold. If this is the first time you've seen the covered call explained, you might need to go over the video again to make sure you understand how really simple it is to make that extra 5 to 12% and more on your stock holdings every year. If you found this video useful, I hope you'll subscribe to my channel for more free premium videos. You can also find out about cash-secured puts in my book, The Amazing Covered Call. It's a way to buy stocks for less than their current price. There's information below and a link. This is Don Singletary, and thank you.